Hello, this is Rich Poston for the Critical Point Podcast, and this podcast is about industrial production index relative to the U.S. economy. We just got some data update this morning here out of the Federal Reserve, and this is out of the FRED system at the St. Louis Federal Reserve. But look at this industrial production chart going all the way back to 1920s. Look at the early 1930s, basically from 1929 into about 1932. Industrial production just moved lower at a steady, consistent pace. But the interesting thing is, look at the more sharp drops off of the last financial crisis, and now look at this crash off the virus recession. We're seeing more violent downturns in industrial production than what we actually saw here in the early 1930s, in my opinion, just an opinion. And I do realize it's possible we should be taking this chart and look at it as a rate of change basis or some kind of log chart or something. Might give us a little bit different feel. But here's something else to look at. These gray zones or columns you see on this chart are recessions. Now the thing is, look, we had recessions frequently up until about 1980. And that's when we had the Republican conservative pro-capitalism revolution starting with the symbol President Reagan. And we also were fighting inflation. We were fighting higher interest rates. And we won on all those accounts. And so you then see less frequent recessions. We also had the Federal Reserve pumping that, trying to help make sure the trend lasts as long as possible and that it contains or restrains recession downturns. And notice it really couldn't do that well in the Great Recession, but actually the stock market was supposed to be down 79%, and I correctly forecast that we're going to get a new statistic. Stock market would drop down 40 to 60%, which is the third most important super cycle. And it did just that. So it was really the second most important super cycle since the Great Depression. And we can see some economic data turning down were as nearly as bad as the Great Depression, at least as bad. But we can also see in the stock market that it didn't perform that well to the downside relative to that super cycle. But at least, like I say, looking at the expanded model, looking at anything and everything, looking at the mechanics, the machine, if you will, we were able to detect that it wouldn't be that severe of a bear market. And we're really not due for that severe of a bear market now, but the point is there can be more things coming down the road. This could be like a 1929, 1930 scenario in the sense that it's a miniature version, that it just takes a while to work through all this bad data. There can still be more downside coming here, but I don't see a 1929 crash. The super cycles are saying no, this is actually a bull market into the late 2030s for the stocks and the economy. But anyway, sizable reduction. Now, here's the 9-year cycle. All right, it should do this. All right, it bottomed, went up. It was supposed to come down at a slower pace than this. This was a record drop, and then it's going to go up again. Okay, now here's the prior 9-year business cycle. See how that works? And we can find more of them back to 1980. Now it gets a little more complicated that we get what I call secondary recessions. If we get a recession, but the cycle is not the 9-year, it's a smaller cycle, then I call it a secondary recession. It's not as important in my book. And some secondary recessions aren't even called these days by economists and the Federal Reserve and government. Okay, so it's possible we actually have more secondary recessions than what we're seeing since 1980. It's just by their measurements, they are no longer detecting those, let's put it that way. Okay, at any rate, very interesting scenario here, and it looks ugly. It looks like we're falling off a cliff, but the bottom line is we will be back to doing business eventually, and I'm going to stick with the forecast that there's going to be a bottom in the economy this year or next. There's going to be a bottom in the stock market this year or next, with a preference for this year, if not already in place in March. And even if it's not in place relative to fundamentals in the economy, we may have just seen the lowest price in the stock market. But I can't rule out still lower. At any rate, I hope this has been of some interest to you. I think it's kind of fascinating how our economies work relative to the Industrial Production Index, which also shows recessions and shows cyclical behavior, business cycles. Please, if you're not a member yet, not following me, go to criticalpoint.podbean.com, click on one of the locked up premium service videos, podcasts, and then click on buy, and you get a 2-week free trial. And because it's just recurring monthly, you can shut it down anytime. We're not locking anybody in for like a year annual subscription or anything like that. But follow me, because we're on a journey for the next 10 years of a bull market in the stock market when there'll be plenty of twists and turns and risk. And I think we're going to do a pretty good job of handling that, dealing with that. Also, you might like our climate research in that in the next few years we see a significant crop problem coming, at least for the Midwest U.S., relative to climate fluctuation. And I do run a model of long-term to super long-term cycles in temperature precipitation that goes along with this global change. Okay, and then we also offer something in the commodity markets, okay, and the financial markets. There's more to be seen, and there's more coming. Give us a chance. criticalpoint.podbean.com. Thank you.